watching Bloomberg Surveillance. I'm Viviana Hurtado. Let's get your Bloomberg Business Flash. And we begin with another event canceled because of the coronavirus. Google scrapping its flagship conference scheduled for May. It's called I/O, and it brings together thousands of people who partner with Google or build apps and websites for the company. Google will try to hold sessions digitally. We end with JP Morgan. It's testing a coronavirus plan for U.S. employees. Thousands today being asked to work from home. Bloomberg has learned about 10% of the staff in consumer banking will work remotely. That division has about 127,000 workers. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Viviana. This is what your stock markets are doing. First of all, futures in the U.S. actually climbing. European equities also up. Investors taking a surprise from the U.S. presidential primary and also expectations of global policy responses to the coronavirus after the Fed's emergency rate cut. Watch out for Andrew Bailey's testimony. That's coming up a little bit later, and definitely money markets are now pricing in a possible cut by the Bank of England as soon as March. That's the next meeting. Andrew Bailey will then be in charge. Also, look out for the 10-year UK yield at a record low. Treasury 10-year yields slip further after breaking below 1% for the first time in 150 years. That was yesterday. Coming up today on Bloomberg TV and Bloomberg Radio, St. Louis Fed President Jim Bullard. He sits down with Bloomberg after the Fed's emergency rate cut. You don't want to miss that. Plus, Bloomberg Surveillance continues on radio. This is Bloomberg.
He leads the company that operates 4 of the most popular cable channels for women, producing a wealth of content distributed around the world. After helping to create MSNBC and CNBC, David Zaslav took the helm at Discovery in 2007, where he moved quickly to streamline the company and relaunch channels so he could take it public, all within the span of a year. Since then, Discovery's market cap has quadrupled. And now, Discovery is coming to terms with a new world, one where viewers increasingly turn to streaming services for their programming and are moving away from Discovery's core business of traditional cable channels, leading Zaslav to make the biggest deal of his life, betting once again on content. On this edition of Bloomberg Big Decisions, David Zaslav. David Zaslav, thank you for joining us. Great to have you.
Great to see you.
So you've just completed the biggest deal of your career, I believe, $12 billion for Scripps. Why did you do it?
Well, it's interesting. There's a financial reason, and there's also a strategic drive that we think could really work for us. Here, we're in the cable and free-to-air business. Scripps is in the cable and free-to-air business. And so we both do the same thing. It's what we do for a living. It's what we know how to do. It's what we do every day when we come to work. And so we feel that we're quite comfortable in putting these two companies together. And the synergy gives us the opportunity to, we think, have a target of doubling our free cash flow. So we generate about $1.4 billion in free cash flow. Scripps generates about $8 billion. And we think we can get to 2, 8, or 3 through revenue synergies by coming up with a lot of cost synergy, mostly cost synergy. And so in a turbulent time, if we can emerge with almost $3 billion of cash, it creates like a moat in a turbulent time. We're different than most media companies in the world, and there are a lot of great companies. But whether it's Disney or whether it's Rupert or Comcast, NBC, CBS, they're mostly in the scripted and movie business. Netflix, Amazon, that whole side of the business is focusing on, as if it was a soccer field, the ball is scripted series and scripted movies. So it's very crowded. It's getting very disrupted. And you know, the number of scripted series have gone from 200 to over 500. And Apple and Amazon and Netflix alone are spending almost $20 billion on top of these companies. So we look at that and we say that we're not that. Well, we're on the other side of the business. The other side of the business is we own all of our content. It's real life entertainment. We see ourselves as a global IP company, whether it's with Oprah, with Discovery, with Animal Planet, with ID and crime or science or cars. And with Scripps having food and HG and cooking and travel, we put it all together now and we're on a different area of the field. And so we say very good luck to them. I think there's a lot of great companies. It's going to be very disrupted. And our game is to take those great brands around the world. And as people over the next few years look to pull content onto devices and phones, we think the functional value of food, home, cooking, science, cars, that we'll do better, or we have a chance to do better, than if we were, if somebody was going to pay to watch The Crown on a mobile phone. So a lot of it is about owning IP and figuring out a way to get to mobile where people will pull your content.
Well, let's talk about getting to mobile, because that's the big disruption everybody in media is talking about as a practical matter. How will this help you get to scale, as it were?
Well, we're about 20% of the viewership in the U.S. at any given time. And we have 4 of the top 6 or 7 cable channels for women with HG, Food, ID, TLC. And then we have OWN that's #1 for African American women. So I think we have a great menu to offer to an advertiser. Discovery is in 220 countries. We have an average of 10 channels in every country in the world. So we're kind of a factory machine of driving IP all around the world. And so we could do what very few media companies could do. We could do a global offering of food. We could do a global offering of all of our content.
In this new world of streaming, will viewers be watching for platforms like HGTV or Discovery, or will they be looking for programs like The Crown, like Game of Thrones?
Well, it's hard to tell behaviorally exactly what people are going to do. But by doing this deal and generating free cash flow and taking a look at the assets that we have, by owning science globally, by owning every piece of IP that we own effectively, except for sports, we're long IP. We've spent a lot of money to own it on all platforms. And that gives us the opportunity, if Amazon said, I'd like to do an offering globally, The only other media company that could do that would be Disney, and it would be in the kids space. And so we would raise our hand and say, terrific, we have a great family offering. And so for us, it's about the long tail. And we think in the end, people that love food are going to pull it. We're not sure exactly how it's going to work, but we think the fact that we own all of our content and we have passionate viewers that they love us like they love a sports team. They'll come home and they put on HG all day long, or they'll put on food. And so we have a sustainable growth business with our synergy. And then we have all this IP that we could take direct to consumer, and we've started to do it.
Can you win in streaming without going through the bundlers? I mean, do you have to be on Hulu? Do you have to be on YouTube? Or can you do it directly? Is your product strong enough?
We don't know. Everywhere else in the world, we're on almost every skinny bundle. Here in the U.S., we're in most of them. We're not on Hulu, and we're not on YouTube, but we're on most of the others. And people love our channels. And so, one, we think that over time we'll get on those skinny bundles. We hope to. We'd like to partner with our distributors because they helped us build our business. And in many cases we are. We're partnering with AT&T on DirecTV Now. We partner with Brian on Comcast on his offerings, with Charter. So that's the best way to do it, kind of regionally. But there is an opportunity for us to go direct to consumer ourselves, which we're already doing in a number of areas, in cars and in sports. But we could also go to those big companies. If you take a look at what NBC, ABC, CBS, and Fox spent 3 years ago, and how much is being spent by Amazon, Netflix, Apple, and Google, there's a massive amount of share shift that's going on there. And these are real global companies, the likes of which we've never seen before. So if any one of those companies wanted to offer for $5.99 a compelling family-friendly service, we would either be most of it, we would argue we'd like to be most of it, or we could be all of it and see how it goes. Because anywhere you go in the world and you say Discovery or Animal Planet or ID or Oprah, people know our brands and they value them.
How will you make that decision about whether you go direct to consumer or you go through middlemen, essentially? How do you make that decision as CEO?
Well, look, right now it's not a fair fight because the direct-to-consumer businesses, the Netflix, the Amazons, we in media used to trade at about a 14 multiple because the view was that this great dual revenue stream cable and free-to-air business would go on forever. And the view now is that it's getting disrupted by some of these direct-to-consumer platforms that are global. There's a question of who's going to emerge and be the winner. We think, looking now, it's only the second or third inning, but we've carved out a very compelling spot of quality brands that people love, that we can offer globally, and we could offer them ourselves.
You stepped up big time on sports. That was a variation from what people had expected from you. Why does that make sense for you? You talk about disruption in media. There was a time not too long ago when you were the disruptor in chief, in some sense. I watched you from Capital Cities ABC across the street as you created MSNBC and NBC. You created CNBC. How does this compare with that disruption when you disrupted broadcast? Basic cable came in and really disrupted it. How does it compare? What did you learn from that experience you can apply now?
Patience. In that case, Jack Welch and Bob Wright were committed to try and take the broadcast business into cable. For people that were around at that time, it was pretty unusual. And it's important because the business that you think you're going to launch that's going to work is never the business that works. The audience is always going to tell you what they get nourished by. And that's what our business is about. That's what most businesses are about. When we launched with Oprah, the Oprah Winfrey Network, we had a dream, Oprah and I, that it was going to be about living your best life. And we looked strategically at the space and said, we can do this. But when we went out with the content, Super Soul Sunday worked terrific, but a lot of the other stuff was too earnest and the audience went away. And we had to figure out, what are they going to come back for? And it took us a lot of years, but we started to listen, what do you like? That's what our business is about. We don't want everyone to watch, but the Oprah Winfrey Network now is the #1 network for African American women. So for us now, we've broken our company in half, essentially. We got half the company that's about growing our channels, doing what we believe we can do as well or better than anyone in the world. Then there's a whole group that has to figure out, okay, how do I get over the top? What do people want when they consume content over the top, you know? And I think you have to be willing to recognize failure and use it kind of optimistically. Good, we know that now.
And you can do it without the blockbusters.
The way people watch our channels, it is hit driven if you're a broadcast network. The way people watch our channels, they come home and HG gets me. Discovery is my channel. TLC in Middle America is the channel that I love. I love Oprah, that's the channel that I watch. That's how they curate. Where do I get nourished? That's the business that we're in. We think that's going to be sustainable, and we think that ultimately they could either pull one of those really big, expensive platforms, or when they're looking to pull something that they want that's family friendly, with brands they know, characters they know, everywhere in the world, for a lot less than they would have to pay for that, we look different. And we got to, over time, we'll see if it's an aggregated offering, if it's an individual offering, but I think we got a game. But the first thing we got to do is execute on this.
You stepped up big time on sports. That was a variation from what people had expected from you. Why does that make sense for you?
Well, first, we're in every country. So when I say we're in every country, we have a sales team, we have a distribution team, we have creative people, we have marketing people, and we have strategic people. So we kind of know each country. And so when we looked at sports, Eurosport was not being individually fed into every country across Europe. So when we bought Eurosport several years ago, we looked and said, we can use our sales infrastructure. We could use our distribution infrastructure to drive more carriage. We could use our sales and marketing people. And it was a little bit of a leap, but it was driven by the idea that content used to be about getting inside of the television box, that rectangle. And even if you had content that was just okay, second or third choice, you did okay. When we launched our direct-to-consumer sports player 3 years ago in Europe, so we reach across 750 million people in Europe. We have the tennis, we have the cycling, we have the winter sports, we have summer sports, we have the Olympics. So we figured we have a great offering. 750 million people, $8, we should be able to do terrific. And we wrote 10 things that we thought we knew for sure. 8 of them were wrong. And the users told us. They said, okay, you know, we tuned in for the French Open, but we didn't want to watch Tour de France. We love tennis. Or they told us that maybe the most interesting takeaway that we applied to the Olympics is that when people consume content on a device, they expect to hit the device when they get up in the morning and see content. And then they expect a few hours later to hit that device. You need to multiple publish. So if speed skating is starting at 2 o'clock in the afternoon, the people that love speed skating have to get up in the morning and see a 1-minute video or 2 one-minute videos or some information about, and we downloaded 700 pieces of short-form content in 21 languages every day to our Olympic player. And that's one of the reasons why we were able to aggregate about 500,000 subscribers. They love the sports IP, But they really, when people look at content on a device, they expect to be entertained and nourished whenever they hit it. And if you hit it and nothing is new, you're disappointed.
Can you do that and not step up into the really high-priced sports projects? Because that, to some extent, sounds a little bit like ESPN in the United States in the early days. They had lesser sports, and then they had to get in the NFL, they had to get in the NBA, and that, as you know, costs enormous amounts of money. Can you have a strategy that stops short of that?
Well, opportunistically, we have taken football. But we haven't taken football where we get in a bidding war with anyone. If you want to offer your content on a pan-European basis, there's only one place to do it, us. Or if you're a federation, if you're the Speed Skating Federation, you could sell it in every country. And the difference between the U.S. and Europe is in the U.S., it's one culture, one language, and everybody likes the same four sports, essentially. 90% of viewing, 80% of viewing is football, baseball, basketball, hockey. In Europe, there's a lot of sports that are number one in Northern Europe that are number 10 in Southern Europe. And if you're a federation, we're the one stop. And we've been very effective about getting a lot of content. And all the sports content we have with Eurosport, we've, as much as we can, we've gotten it long term, and we own it on all platforms.
You have scripts, as you say, you need to execute on that now. But is that enough for Discovery? Are you on the outlook for further acquisitions?
This is news, but not as you know it. This is TikTok by Bloomberg, the first and only global news network built for Twitter. 24/7 news streaming live on Twitter.
You have Scripps, as you say, you need to execute on that now. But is that enough for Discovery? Are you on the outlook for further acquisitions? Do you need to get bigger scale?
Well, look, as I said earlier, we're in a different place of the soccer field than everyone else. So we think if we could execute on this, own all those passion brands globally. Scripps never took food and HG and cooking and travel around the world. So we have an opportunity to take all that IP, we'll convert it into 48 languages, and we'll start to spread it around. So that'll be a revenue synergy if viewership increases, and we think it will. In Latin America, we've bought some of their content. But I like our hand here. We got some work to do. We got to pay down some debt. We got to prove out that we're going to generate that free cash flow and that we really did build a moat. But at the same time, we're going to be working really hard about learning how consumers consume content on devices. And we're talking to every distributor, because we're better off if somebody that's already in business with you and you're already paying a $100 bill can then have a chance to check a box and pick us. Today in the U.S., there's probably 25 or 30 million subscribers that are broadband only. The one service that's being marketed to them heavily is Netflix. And the industry built us, we built them, and together I think we're going to come up with something that's going to be pretty compelling in terms of a skinny bundle, because it's not sensible to have Netflix have all that field without us on it.
You said you need to pay down some debt because you do have more debt on your balance sheet than a lot of other media companies do. You've said you're going to save $350 million a year on Scripps. How are you going to do that? That's a lot of money, as you and I both know, to save in an operation.
Well, look, as we've looked at putting these businesses together, and it's early days. It's only been 5 weeks, but we've been working on it very hard for 6 months going up to it. We think that's rather conservative. These are one-over-one companies. We have 12 channels in the U.S. They have 6. So we're in the same business. We have 220 research people. They have 140 research people. We have 650 salespeople. They have 550 salespeople. And their people are really good. We put some of their people in charge in our new structure. And the idea is, who are the best and the brightest? Because when we looked at it, we said, when it comes to nonfiction, who are the best 2 producers of nonfiction content, and who is best at monetizing it? And we looked and we said, in some areas they're better than us. In some areas we're better than them. We put these 2 together, and we will spend $3.5 billion on content, maybe growing to more than that. This is a hard business. We're in the business of creating stories and characters and getting people to turn on their TV and love it.
You've referred a couple of times to John Malone, who's a shareholder, doesn't control your company by any means, but you know him well. What is it like to have John Malone as somebody you can call up and say, should we do this, should we do that? What do you think about what's going on?
Well, I think about my last 30 years in this business, and it's sort of like what you want for your children. You are who you hang out with. And it really helps define you, the narratives that you hear, the questions that you hear. And so I look back over the last 30 years and 15 years listening to why Jack didn't want to do an acquisition that we brought him, or what we need to do with cable, how we need to do it. Bob Wright, one of the most successful guys running NBC, the Newhouse family, Donald and Cy Newhouse, and Bob Myron, who's a genius and has been in the cable business and built Bright House, and John Malone. And so when I think about where people should be spending their time, yes, you'd like to get the right job. Yes, you'd like to think that you're going to make some money. But I took a 50% pay cut to go to NBC from a law firm because I thought I can get to hang out with the guys at the Peacock, and maybe someday I'll get to meet Jack. And a lot of the way I see the world, I still talk to Jack all the time. So I'm hearing Jack's voice, I'm hearing Bob Myron and Donald Newhouse's voice, and I'm hearing John's voice. And so for that alone, I'm one of the luckiest guys.
It strikes me that you're now running Discovery, which really appeals in the United States to a lot of the middle of the country. People that the President of the United States probably wouldn't object to. In fact, I understand the President of the United States is a fan of Shark Week. Actually, I read that someplace.
I hope he's a fan of a lot of our stuff. I think, I hope.
You helped create MSNBC. That is a channel in a very different place. What do you think about the media landscape today in the United States in terms of politics? Because it seems to become much more polarized.
Well, I can just say that the business changed. When we launched MSNBC, Brokaw and I and Andy Lack and Tom Rogers, there was a group of us, and Jack said, we're going to launch the best news network in America, and we're going to use the #1 news division in the world to do it. We had this amazing library. We structured a deal with Microsoft to get them in. They wanted the library at the time, and that was our ambition. I'm not going to game out the different news networks in America, but we have to be practical and recognize that at least some of them are following that model, because you on the one hand you want to do the best journalism possible. On the other hand, you want people to watch you, and you want them to watch you for as long as possible. And part of the way we as human beings determine our success is, are we in third place? Are we in second place? How many people are watching us? How many people love us? And so I think that's the journey. And luckily, I'm not going to be one of the guys to figure that out.
Well, but let's talk about how you keep score. That leads us exactly to a great conclusion here. How do you keep score? I mean, I see that now you've jumped up in the rankings, actually, including broadcast and cable. Big step up with Scripps. Is that the way you keep score? Is that how you just tell whether you, David Zaslav, are succeeding?
No, because there's lots of books that have been written about, more scale tips you over. So we're staying in our lane. And what's going to be successful for us, and we've made this decision. On every one of our channels, we've said, if you don't love us, if you're not one of the passionate viewers that loves survival, if you're not one of the people that love science or that love crime, go find some other channels that you love. When we're creating content for our channels, we want global audiences that really affiliate and have a passion for our characters and our message. And a big piece of that is we're not going for the best rating. We're going for the most potent audience that says, they get me. When I go there, I see something that I love. And if we put something on any of these channels that looks like we're going for ratings, they'll immediately say, what's this doing on here? And so they're quite clever, and you just got to continue. This is what we do for a living. Figure them out on TV and try and figure them out in terms of the devices as to what they're going to love and what they're going to pay for.
David Zaslav, thank you so much for spending time with us today.
Thanks, David. Good to see you.
Coca-Cola, a 130-year-old iconic brand and a dominant force in the $800 billion soft drink industry. Synonymous with globalization, Coca-Cola operates in over 200 countries worldwide. The beverage behemoth now has a new CEO. James Quincy spent the last 2 decades rising through the ranks at Coca-Cola. Now, as head of the company, Quincy aims to win over a new generation that shuns sugar, and to show the world that he takes the environment seriously. even as he adapts to a new world of technology. James Quincy sat down with us for an extended conversation. We wanted to understand how he plans to use innovation to transform every aspect of Coca-Cola, attempting to change its culture while managing a global checkerboard of regulations and tax regimes. Coca-Cola operates in a lot of different countries, which means there's a lot of different regulatory systems, a lot of different legal schemes you have to really adapt to. Let's talk about a couple of those. First of all, the United States. The tax cuts. How does it affect Coca-Cola?
Yeah, we're still working through the numbers. I mean, our tax rate last year effectively was about 24%, so it's not the biggest change to us. Because we're an international company, the absolute rate hasn't affected us as much as perhaps some of the more domestically focused enterprises. But we're positive on moving the territorial system. So we think the simplification is positive in the long run. To the extent that it helped create more demand, that will be good news. Too, we're still working through the numbers that we'll lay out on our earnings call. Of course, we're part of having some of the money overseas, but in the end, if it generates more economic growth, that will lift all the boats.
Does the expensing of capital investment affect you at all?
Not in a great amount. I mean, it will make some difference. We'll lay that out, but that's not the biggest moving piece for us.
And if there is significant incremental cash available to Coca-Cola, have you decided yet, does it go into capital investment? Does it go into buybacks of shares? Does it go into dividends?
I mean, we weren't short of cash at the end of the day. So, we've been a successful company. We've got the resources we need to invest in the marketplace. We're still working through exactly how the puts and takes work, because obviously you've got to pay tax on the cash first, or in addition. So we're looking at how we use all that and how we make the right capital allocations.
One of the really big issues for the United States right now is the so-called dreamers. These are the young people who were brought here as children. And the question is, do they get to stay as adults, essentially? Do you have at Coca-Cola people who are really uncertain about whether they can stay or not? There are about 700,000, more or less, nationwide.
Yeah, we have some people in our company and in our bottling partners who fall under the Dreamers or the DACA program. We would love government to find a way to make proper underlying immigration reform, and including finding a solution for the Dreamers, so that it's not so disruptive, and then they can stay. So hopefully they'll find a path to that. Of course, partial solutions may be necessary, but we would love to see fundamental reform.
You ran Mexico for Coca-Cola at one point, so you have seen this issue on both sides of at least our southern border. Do you see a path forward, a constructive path forward on immigration?
I think there's a path forward, but I think it also is connected, and it can't be completely disassociated when you think about long-term fundamental reform from getting both economies to grow. In the end, part of what drives the informal immigration is the disparity in the economic outlook. So having a community of North America where all the economies are growing actually solve that problem too. So I think, leadership from the United States to drive growth will help solve some of these other issues too.
You've also seen NAFTA from both sides of the border. You've seen that issue, which is another hot issue right now in the United States. Has NAFTA overall been good or bad for the United States?
My view would be that free trade deals are good overall for all participants, and I think it's been good for North America and all the countries in it. Doesn't mean it's perfect. Very few free trade deals are perfect. So can it be made better? Yes, I hope they can make it better. But I don't think we should start deconstructing global trade. I think it's been a powerful engine for lifting all boats. It doesn't mean it solved all problems. There are questions of income inequality. There are questions of not all the rules were perfect and need to be improved. But let's go forward, not backwards.
So when President Trump first came in, he was very closely allied with many people in business. He consulted, and he had panels that he talked with as well. Do you get to talk, either President Trump or the administration, about things like NAFTA? I mean, do they consult you, or do you make your views known to them?
When there are things where we have a view or it affects our business, we make our views known either directly to the administration or through many of the business forums, like the Business Roundtable. There are enough points of intersection collectively and individually with the administration that everyone they know what we think.
So from that, do you have any sense of where we're headed with NAFTA? Because there are conflicting reports. I mean, the Canadians seem to be preparing for actually U.S. withdrawal. There are a lot of people in Washington say, no, we're not going to withdraw. Do you have any sense from your point of view of where we're headed?
My view on negotiations is you've got to let the negotiations negotiate. And if you're not in the room, you don't know what the answer is until it comes out. So I think the important thing for those that aren't in the room is to keep saying what they believe to be true, what they believe to be the areas where things can be made better. And then the negotiators have got to get in the room and thrash it out, and trying to work out what color the smoke is coming from the room doesn't lead you anywhere until they come out and tell you what the answer is.
Your native country has voted in a referendum to leave the EU. And I won't ask you what you think about that, but tell us how that's developing. I mean, is there a soft landing there that you can see? How would we get to it?
It does a bit go back to my point about negotiations. You're never really sure until the cake is cooked. I think the logic of the economics is a softer rather than a harder Brexit. I think in the end, whilst it won't be a catastrophe one way or the other, life will be better. There'll be more economic growth if it's a softer Brexit, but there's a lot of details and a lot of different points of view to work out, because in the end, the referendum wasn't between do you want this or that. It's like, do you want this or not want this? It wasn't a referendum around the version of the exit, which is kind of where we're trapped at the moment. And of course, there's a lot of negotiations going on. It's very important to get it right for the UK and to some extent for Europe as well.
Whether it's Brexit or whether it's NAFTA, how do these trade issues affect Coca-Cola's business?
I think one of the great benefits of the Coca-Cola system is we're global, but we're extremely local. I mean, we manufacture in every country virtually that we sell in. Virtually everything that's sold in the US is made in the US. Virtually everything that's sold in Mexico is made in Mexico. Virtually everything that's sold in the UK or France is made in that individual country. So the global trade restrictions or openings don't tend to affect us heavily in the moment. To the extent that they reduce or increase total economic growth, that's what matters to us. And so I think philosophically, we're pro global free trade because it drives economic growth. Therefore, let's focus on making those deals better because it will provide the wealth to then solve a lot of society's problems.
You came in and took over Coca-Cola and really trumpeted innovation as critical to your future. I believe you have a chief innovation officer, but maybe you're the chief innovation officer in some sense. How do you innovate in a 130-year-old company that's so well known around the world, has been there for so long, has such an entrenched perception of people's views?
It's hard. I mean, any institution that's been around a long time, whether it's a company or a government or any organization, it's going to be very hard. So I think from my point of view, if I'm not the chief innovator, I'm certainly the chief agitator for innovation. And what that means is, driving the culture to try and do a few things upon top of everything else we do. Stay curious. If we're not curious about the outside world, about the consumers, about the customer, about what's changing, how will we innovate? But curiosity just leads you to an insight. It's very passive. You need to drive empowerment so people feel they can go and do something, that they're not waiting for head office to make the decision, that they can get up in the morning and go and do something. And I think the next thing is you've got to be inclusive. You've got to try and connect the pieces because we've got a tremendous global knowledge and tremendous global system. Sometimes your idea has already been tried somewhere else. So connect to the other parts of the system. And lastly, we probably fell into the trap of trying to make things perfect before we did anything in the past. No, we need to learn from some of the software companies, have version 1.0, 2.0, 3.0. That gets us both innovation and speed. And if we keep pushing those four things, I think we'll make progress.
And how do you know? How does James Quincy know whether you're getting the innovation job done? And I mean that in the sense you're sitting atop a very large organization, a lot of people spread around the world. How do you judge whether the word's getting down and people are already changing their behavior?
It's hard to know, but the only way forward is to look for multiple signals. There's no one number or one metric that's going to give it the answer. So we have employee surveys where we ask people. We can look at the sales number and measure the success rate or the number and the success rate of the things we put into the marketplace. We can look at what our research and development pipeline is generating, and are we really getting new patents? Are we really making progress? So I think one has to have a dashboard to look across and say, is there progress?
How is technology changing the way you do business, and for that matter, your workforce?
This is news, but not as you know it. This is TikTok by Bloomberg, the first and only global news network built for Twitter. Objective reporting that you can trust. Curated comments that provide insight. TikTok by Bloomberg. 24/7 news streaming live on Twitter.
Technology. It's disrupting just about every company that we know of today. How is it affecting Coca-Cola? And first, talk about how it's affecting your relationship with your consumer. How you deliver to your consumer, things like e-commerce, how you market to your consumer.
Yeah, I mean, we kind of look at it in three buckets. How we engage with consumers, there used to be TV advertising, now there's social media. The ways of engaging with the consumer are changing rapidly. Who the customer is and how the shopping actually happens is changing rapidly. And of course, internally, it's changing rapidly. With the consumer, around the world, TV is still the biggest vehicle, maybe less so in some of the developed economies, but around the world, it's still the biggest vehicle, but a lot of it's going into social media. We work closely with a lot of the new tech companies in social media, trying to find ways to continue to have a brand role. I mean, in the end, someone's got to pay for the content to be developed, whether that's through advertising or sponsorship. So I think there's a lot of change going on. We're adapting. I think we feel we're kind of towards the front end. But what I'm totally clear of is going to be different in 5 years, and it's going to be very different in 10 years. And we're going to have to keep investing in innovation and keep evolving to stay close to the consumers.
As you look around the world, which markets do you see the fastest innovation when it comes to e-commerce? When we just sort of get on your app and you order something up, it gets delivered, for example. Is it China? Is it the United States? Is it Europe?
I actually think that places like Shanghai and some parts of Western Europe are on the cutting edge, along with some of the bits of the U.S., but really at a par. I mean, the U.S. in many respects, there's a lot of advanced e-commerce, but I can tell you it's very advanced in places like Shanghai and Western Europe as well, and the penetration of e-commerce in aggregate is even higher in some of those places than even the U.S. So, when you want to learn what's going on, I would be just as tempted to tell you go to Shanghai as stay in New York.
And how do you market in that circumstance? I mean, we're used to going to a fast food restaurant, for example, and there's a Coca-Cola there. It's on the menu.
Yeah.
So let's have that Coke or that Diet Coke.
Yeah.
You don't have that when you're on your app.
No, but you have to get it. I mean, if you went back even 2 or 3 years in China, for example, when a lot of the apps and the mobile payment systems came in, we weren't on the menu. Actually, even worse, we were trying to sell perhaps a returnable glass bottle to the restaurant, which had no way of being in the delivery system. So we've had to re-engineer our business system very quickly to both be present on the app. So what's the virtual representation of what you'd normally see in the store? And how do we change the packaging portfolio so that we can be part of the delivery system? And you have a lot of places in Shanghai where food ordered on apps and delivered is 30-50% of the restaurant sales.
That's the relationship with the consumer. Talk about Coca-Cola as Coca-Cola. How is technology changing the way you do business, and for that matter, your workforce?
It's changing it in lots of profound ways. I mean, in simple terms, you go back 10, 20 years, we were a large company and we're one of the few that could afford to invest in expensive IT systems and do our own stuff, our own programs, our own server farms. You wind forward to today, that's no longer the model. We've had to move to the cloud. We've had to move to standard programs that whole industries use, and we've had to use the mobile. The one thing I always say to the IT department is, just put it on the phone. Everything can be done on the phone. Let's just move everything to mobile on the phone. The old days of IT had training budgets. Why? Everyone knows how to use the apps on the phone. So it's profoundly changing the way that we work, and I think it's going to continue to flow through the organization. We have a big program of digitizing the company.
Does that translate into fewer employees as a practical matter because of the efficiencies from digital?
I think it for sure it changes into a different profile. I mean, people are having to adapt to doing things in a different way. We've actually made a lot of changes in our IT departments to move to a different skill set. So it's certainly changing the nature of employment and the sorts of profiles you want. Whether we buy the services ourselves or we buy the services or do it ourselves makes a difference as to where the employees are. But net, more employment's being generated in the economies.
So can Coca-Cola compete with Silicon Valley and the digital startups when you're trying to recruit the young computer scientists?
Well, Atlanta is a very fast-growing economy. The state of Georgia has been ranked, top 1 or 2 of place to do business in the U.S. for many years in a row. The local political system has done a great job, so has the city. So it's a very competitive economy there, and we do very well in it. We're happy to see Atlanta and Georgia growing, and they've done a lot to invest in tech startups and the media industry in and near Atlanta, and it's being very successful.
As you look toward really substantial growth in these new beverage categories, are you looking at acquisitions? Are you looking at organic growth? I mean, you have been inclined, I believe, to look for smaller brands, startup brands, bringing them along. Is that the future path to a significant degree for Coca-Cola?
I think it's going to be both. I mean, we have grown organically, but we have made these bolt-on acquisitions, as we call them, the little small ones, the niche brands. I think where we see that something is a really good idea, we invest in them. Sometimes we buy them. Sometimes we just invest with them. But there's a quid pro quo. They get the capital that we inject, yet we can introduce them to the globe, not just the country that they've launched in. And that's helped us double the number of billion-dollar brands that we sell around the world. So I think it's going to be an and strategy rather than one or the other.
It's interesting. It's a total beverage company. It's not a food company. I mean, there are some competitors who said, let's become a food company, at least in part. Why did you make that decision? And does it make you any more vulnerable, forgive me for saying, but even to acquisition? I mean, you're $200 billion market cap. It's a pretty big acquisition. But there are some pretty big consolidations in the food industry out there.
I think firstly, we're focused on beverages because that's where the greatest synergy and the greatest application of our know-how and our fabulous global bottling distribution system is. It's the thing that can be most synergistic with what we've already got. And the market for beverages is one of the best growing markets in the whole of the supermarket or in the other stores. So it's a great market. We have a good position. We can create a lot of synergy. So it's a question of choices. I sometimes say never say never, which then causes confusion because people say you haven't ruled anything out. I say no, it's a question of what's most logical. And beverages are the most not logical thing for us to do first because we stick to our knitting. In terms of how we think about the consolidation, in the end of the day, I'm pretty convinced that investors, gold star goes to those that grow with expanding margins. Growth is the name of the game. If the category's got no growth, then optimize the margin. Okay, but that's still silver prize largely over the long term. So I'm pretty clear. If we focus on driving top-line growth, which we believe we can with our strategy of total beverages. We will attract an investor base that will be very happy with us over the long run.
By 2030, you want to be getting a bottle back for everyone you put out there. That's a lot of bottles for Coca-Cola. How are you going to attract all that plastic? World without waste. Great goal. You have a big new packaging announcement. Why is it important to Coca-Cola, not just as a corporate citizen, but as a business?
It's important to us for a very core part of our values. We've always believed that to have a healthy business, you need to be operating in a healthy community. And one of today's biggest problems is packaging waste. We've done a lot on making things recyclable. We've actually invested a lot of R&D making progress on reusing it. What we need to do is collect it. So this announcement is about the big missing piece in generating a world without waste, which is collecting back the plastic and creating a market economy for that collected plastic. And I think that's going to do great things to help us grow into the future without creating waste, which is good for us and it's great for communities.
How are you going to attract all that plastic? By 2030, you want to be getting a bottle back for everyone you put out there. That's a lot of bottles for Coca-Cola. How are you going to attract all that plastic?
Well, to give you an idea of the dimension, we need to bring back, every person in the world, if they bring back 2 bottles a month, we bring back all our bottles. That's our objective. 2 bottles a month for every person. We collect every bottle we put out. How are we going to do it? Well, there'll be different systems in different countries. Every country needs a solution, but it won't be the same everywhere. There are kind of places where it's reasonably advanced in Europe, to more informal economies where the collection happens. So there's going to be different solutions everywhere. We're going to have to work with NGOs, other industrial companies and governments to put in place these solutions. But it's absolutely doable. And I think that's what's exciting about setting the objective.
We're very conscious of this in the United States, but what about in other places, like China, for example?
Yeah, look, I think the emerging and the developed countries are where more of the problem is than the US or Europe, which is probably at the leading edge. So we need to do more there. But recognize that in a lot of these countries, there is some informal collection system already going on across a wide range of waste. What we need to create is the circular economy. We need to create value for that. So often in the case, and we did this in Mexico, for example, you go back a little more than 10 years, it was less than 10% of the plastic was recycled. Now it's 60%. How? The informal economy was collecting the waste, but there was no market for it. No one wanted to buy it. So we went into the marketplace and bought the plastic, invested in factories to recycle that and reuse it in our bottles. So I think there's a model there for the Chinas and other parts of the world on how to create value out of plastic and get it reused.
You've laid out a bold strategic vision for your company called Total Beverage Company that includes things beyond Coca-Cola and even beyond Diet Coke. It goes on beyond that to these 5 categories. What's driving that? Is that basically to get away a bit from sugar drinks?
Actually, we're following the consumer. When you look at what's happening around the world, as the world is urbanizing, as people have got more disposable income, they're spending more money on a range of things, including beverages. So what's important within that growing market of beverages is they want more choice. Different people want different things. So if we really want to be able to serve the customer, serve the consumer, we've got to follow them. We've got to get into more categories. Coke is likely to remain the heart and soul of the company. It's the world's biggest, fast-moving consumer good brand. But we need more. We need to offer consumers what they want all day long. We have to offer choice. And I think that's what's going to guide us forward. And in a way, it goes back to where we started. If we pay a lot of attention to what the consumer wants, they will take us to where the business needs to grow. And then it ultimately ends up in growth for the business.
I understand that on average around the world, people consume about 8 ounces of a beverage per day. And Coca-Cola, I was told, is about a half an ounce. What is your goal? How much of the market share of total beverage can you really take globally?
I don't think there's a end of history moment when we reach nirvana. I think what we're looking to do is gain share every year. I mean, it's a competitive marketplace. We have a lot of well-funded competitors doing a lot of exciting things. So what we're focused on is, can we serve the consumers and gain a little bit of share each year and generate a growing business system that our objective is to create value for everyone who touches that business system, whether it be the economics of the people who are in the value chain like the customer, or even society with initiatives like the packaging one, which I think builds on our heritage of creating shared value in the world. 10 years ago or so, we set ourselves the objective of being water neutral by 2020, and we achieved it a few years early. So we return to the environment all the water we use, which is one of the things that gives us confidence that we can achieve this packaging objective. So we get business growth and doing it in the right way for society.
Okay, thanks very much. That's where we're wrapping up there. This was terrific. Thank you so much. That was really fun.
Thank you.